So starting from inheritance tax, I hope you would know the basics, but we will give it a quick review that what are the basics of inheritance tax. And for that, we can start from this table so that we can have some basic understandings of how IHT is communicated. Well, if we have a look at definition of IHT, that is when a chargeable person makes transfer value of a chargeable property, implications of IHT may apply. So, whenever a person makes transfer of value of a chargeable property, a person would be able to do that either in his lifetime or maybe on his death when he will be transferring the assets from his death state through will. So we should be focusing on that how IHT is calculated when someone makes a transfer of value during his lifetime and when someone transfers some value on his death. First, we'll be focusing on lifetime transfers, and to do that, let's move to the table I was referring to you guys earlier. Well, with respect to lifetime transfers, as you would have a basic knowledge that we consider the lifetime transfers into three categories. Well, the most important one are potentially exempt transfers and chargeable lifetime transfers. Well, there are a few transfers which are exempt, which we will be discussing shortly after we will be done with the potentially exempt transfers and chargeable lifetime transfers. First of all, what are potentially exempt transfers? Those transfers which are made by an individual to any other individual are considered as chargeable lifetime transfers. Well, if you want to know the definition of any transfer, I've written it up there. Any transfer which is made by an individual to another individual, or just one trust which you have to keep in your mind is which is considered as pet. So any transfer which is made by an individual to another individual or to a trust which is made for disabled person or disabled person trust, those are considered as potentially exempt transfers, whereas the transfers which are made by an individual to any trust which is except for trusts which are working for charitable purposes and those trusts which are treated as PET, that is disabled trust. So any transfers which are to charitable trust or disabled trust would not be considered as CLT. Rest, if it is transferred to discretionary trust, or if it is a transfer to interest in possession trust, or it is a transfer to relevant property trust, we will consider it chargeable lifetime transfers. If you want to know what is the treatment for these transfers, let's have a look at this table now finally for the treatment. All those potentially exempt transfers which an individual makes in his lifetime, make sure we do not calculate any IHT on potentially exempt transfers. I will call them PETs from now onward. So there are no lifetime taxes to be calculated on potentially exempt transfers, but yes, we have to calculate lifetime tax on chargeable lifetime transfers as their name refers. So PETs are those transfers who do not attract any lifetime taxes, but CLTs are those on which we calculate lifetime tax using lifetime rates, which are usually 20%. All right, so in the lifetime we will only be calculating tax on CLTs but not PET. What would be the implications of these lifetime transfers when an individual dies? Well, that depends whether individual lives for 7 years after making this transfer or he dies within 7 years of making these transfers. First of all, let's have a focus on potentially exempt transfers. If an individual makes a potentially exempt transfer, there haven't been paid any lifetime taxes, but if he lives for 7 more years after making this transfer, he would not pay any IHT either in lifetime or in death calculations. But if he would die within 7 years, this pet would not remain pet as it would become a chargeable transfer, and then we will be calculating death tax on this transfer at the rate of 40%, which are the rate for death calculations. But if it is CLT, once again, things would be dependent upon whether the individual lives for 7 years or he dies within 7 years. If he lives for 7 years, whatever the lifetime tax which we had paid has been paid, that would not be repaid to you in any case. But if the client lives for 7 years after making this transfer, we would not be required to calculate any further IHT on death calculations of this lifetime transfer. But after making a CLT, if an individual dies within 7 years, in that case, we will be calculating IHT on 40%, obviously the death rate, but we will be deducting whatever the lifetime tax we have already paid, and remaining taxes would still be payable. So this is the treatment which we do for lifetime transfers. Now, if you want to know that how do we do the calculations, precise calculations on these transfers, we have to look at some examples. So now we are focusing on that how to do lifetime calculations if an individual wants to make a lifetime transfer to either another individual which are considered as pet, or to another or to a trust which will be considered as CLT. So these are the precise calculations an individual is required to do when he will be doing lifetime calculations on lifetime transfers. Well, either it is potentially exempt transfer or it is CLT in the death calculations. So we apply death rates on same chargeable amount which we have calculated during lifetime. So we will be calculating chargeable amount in the lifetime calculations, and if he would die within 7 years, we will be applying death rate on the same chargeable amount, both in the case of pets as well as CLTs. But when we say lifetime calculations, what we are precisely required to do? For pets, we are only required to calculate chargeable amounts, but for CLTs, we are required to calculate two things. One is chargeable amount, and second is lifetime tax on this lifetime CLT. So, how do we calculate chargeable amount? First of all, we are required to calculate transfer of value, about which we will be talking in detail in the later part of this session. But right now, you can say transfer of value is what is the diminution in value, what is the reduction in value of state of the donor. So that's why a basic idea would be, we'll be comparing what was the value of state of donor before making transfer and what was the value of state after making transfer. Whatever difference would be, that is the value which has been transferred. I can give you a small example to explain that. Well, if Mr. A owns 3 shops, out of which he wanted to transfer just one of the shop to his daughter, what would be the transfer of value? Make sure candidates are not required to prints. That is actually called transfer of value. So right now, he had 3 units which will be of worth 190,000 before making transfer. After transfer, he still have a property of 2 units. So before making transfer, he was owner of 190,000 worth of state, but after making transfer, it is just 100,000. So we can say the value he just transferred in respect of this potentially exempt transfer is 90,000. So we just have to compare what were the values of estate before making transfer and what was the value of state after making transfer. The difference will be transfer of value. So once we have calculated the transfer of value, either PET or CLT, the next thing will be we should consider what are the available for value, and remaining is the chargeable amount, which would attract a lifetime tax in the case of CLT, but in the case of PET, there would not be any lifetime taxes. So both cases, we need chargeable amount, and in order to calculate that, you should know what are the criteria to claim exemptions. Well, for that, let's have a look at exemptions. The first exemption which we may have to deal is small gift exemption. If an individual makes a lifetime transfer of up to 250 per person per tax year, that means the transfer of value is below 250 and nothing has been transferred to the same individual, which makes a total transfer of more than 250 in a tax year. In that case, it would be exempt. So 250 per person per tax year. So if that is the case, we would not say it's a PET, we would not say it's a CLT, we'll say it's an exempt transfer, which, by the way, would become the third category, the exempt transfer. So what are exempt transfers? Transfers which would not be considered as PET, nor they will be considered as CLT because of the application of any of the exemptions we are right now discussing. So the next exemption which we can discuss right now is transfer within spouses and civil partners. Make sure if the receiving spouse is a domiciled spouse, any transfer made would not be considered as potentially exempt transfer. Rather, it would be considered as an exempt transfer straight away. But if the receiving spouse is a non-UK domiciled and have not made any elections for being a deemed domicile, in that case, the maximum transfer which our client could do to such a spouse, which should be considered as an exempt transfer, is restricted up to 3,25,000 lifetime. So any transfers which will be made above 325,000 to a non-UK domiciled spouse would be considered as chargeable amount of potentially exempt transfers. But if a non-UK domicile spouse became deemed domicile because of any of the three reasons which will be discussed in the later part of this in the session, in that case, yes, we can transfer an unlimited exempt amount to such a spouse who is deemed domicile either through election or deemed domicile because of either of the other two reasons which we still have to discuss. Next exemption will be normal expenditure out of income. Well, this exemption would be applicable upon any transfer of value either to a trust or to an individual. But if we will be able to confirm this with HMRC that the transfer which our client made in fact does not have any impact upon standard of living of our client, because the income which he earns is quite material, that the transfer of value is immaterial amount in respect of that income per annum income our client is earning. So for example, if an individual is earning £200,000 of incomes a year and he's transferring a £2,000 or £1,000, we may be able to successfully argue with HMRC that this transfer is merely an expense out of income rather than an asset out of state, and it does not have any impact upon standard of living. And so, if this exemption would apply, this transfer would be considered as an exempt transfer. Moving on to marriage exemption. This exemption would be applicable whenever donor is gifting something upon marriage of someone. Well, the exemption depends upon whether the donor is parent to the groom and bride, or grandparent to groom and bride, or any other relation than being parent or grandparent. And if you are a party to marriage, in that case, exemption is 2,500. But all these exemptions are applicable if if the marriage takes place ultimately. If it has been cancelled, exemptions would not be available. Well, the fifth exemption is if an individual is transferring any value to any approved UK charity, or to a party which is a qualifying political party. Well, for a charity to be a qualifying charity, it just needs to be approved charity. But for a political party to be qualifying for an exempt transfer, we need to we need to consider the following two conditions. Either of the two conditions must be met in order for a party to be considered as qualifying. Well, the first one is there should be at least 2 elected members in the House of Commons, but the second condition allows even if there is one member, but in this case, the total votes casted to the party should be at least 150,000. So if this exemption apply, once again, the transfer would be referred as an exempt transfer rather than a chargeable one. Well, the next exemption applicable is annual exemption. As far as annual exemption is concerned, that is £3,000 per tax year. But in IHT, we have a facility that we can carry forward exemption of previous one tax year, and we can carry it forward for just one tax year. So, for instance, if we have not made any lifetime transfer in 16-17, in 17-18, we will be provided with an exemption of totaling 6,000. But make sure whenever you will be deducting 2 annual exemptions out of any transfer, you must deduct annual exemption of the tax year in which transfer was made first, and then the annual exemption which has been carried forward. As that's a rule, you would not be able to amend it for your own benefits. Now, speaking of all the 7 exemptions, there are 2 more. One is called business property relief, and another is called agricultural property relief, which we will be discussing after few examples. We will be discussing on the basic calculations on lifetime transfers. Well, if you want to know that how we will apply all these 7 exemptions, we can try this test your understanding, which I have quoted from Kaplan. Margaret is someone who's making transfers, who's making several transfers in the same tax year. And how I get to know that she's making them in the same tax year? For that, you just have to notice the transfer dates. Well, all of these transfer dates, I think, belongs to one tax year, and that tax year will be tax year 17-18. Well, so I think the earlier transfer, date-wise, whatever the earlier transfers would be, those would be the transfers which will be able to claim annual exemption, because annual exemption is to be deducted chronologically, that is date-wise. Whichever transfer was made earlier in the tax year would attract annual exemption first, and if any left after deducting from the first transfer, we can deduct it from the subsequent transfers as well. But if there is any exemption left. Now, as we have not been provided with any information that whether she made any lifetime transfer during 16-17. So, for that reason, I would say that we will be provided with two annual exemptions in tax year 17-18. One is obviously of 17-18, 3,000, and other would be the carried forward one from tax year 16-17. So the first transfer which Margaret made was unquoted shares were husband on 1st June 17. Now, this transfer will be an outright exempt transfer if her husband is a UK domiciled individual, which will be definitely given in your exam if he would be. But you would only be able to deduct only £325,000 out of 525, and rest you can deduct two annual exemptions if his husband is a non-UK domiciled individual. Well, I will be assuming that his husband is a UK domicile, and that's why this 525,000 transfer would not be considered as a PET. Rather, it would be considered as an exempt transfer from because his husband is a UK domicile. Well, in that case, the first transfer which he would be making, which would have any IST implications, would be the one which would be made on 6th of July 2017. 15,000 to her son as a wedding present. Now, if you want to know that what would be the transfer of value of this transfer, which he made on 6th of July 2017, well, the transfer value is kind of given actually. That is 15,000, but we'll be deducting a marriage exemption of 5,000 out of it, and then we will be able to deduct two annual exemptions out of it. And because of that, we would say the chargeable amount of this potentially exempt transfer, because it is transferred to son, is remaining 6,000. Now, keep in mind, you have already used annual exemption for the tax year 17-18. As we can see, all the rest of the transfers are also in the same tax year. Now, you would not be able to claim annual exemption on any of the following. Then he transferred 20,000 to her nephew on 27th of September 2017. I'm afraid that's a PET whose transfer value is a chargeable amount, as we are not left with any exemption to be applicable on it. Well, as nephew is not getting married, we could only consider annual exemption, which we have already utilized in the transfer made on 6th of July 2017. Well, the next transfer which she made was of 235 to her friend for her 40th birthday on 4th of November 17. Well, I would say, although it is to an individual, but still it would not be PET, as small gift exemption would apply, and we would not consider this transfer now or in the death calculations, that because this transfer is not PET, it's not CLT, it is an exempt transfer right now and ever, regardless of he dying within 7 or after 7. Then 270,000 to a discretionary trust from 24th of December 2017. Now that's a CLT which he made, and once again, as we have used annual exemption of this tax year already, 270,000 is a transfer value and is also chargeable amount. Then 90,000 to International Red Cross, a registered charity, on 1st January 18. Well, this needs to be considered as an exempt transfer. And then 20,000 to Labour Party on 14th February 2018. I think everyone knows that Labour Party would have more than 2 elected members, and that's why that's an approved qualifying political party. And this transfer is also considered as an exempt transfer. All right. So this is how we calculate chargeable amounts of either PETs or CLTs. Now, you should be able to do Now you should be able to calculate chargeable amounts on both PETs and CLTs, because it would be calculation of transfer value, then deducting exemptions, and that would be chargeable amount. Now, the next step which we need to do will be how to calculate lifetime taxes using lifetime rates on CLTs. Well, to do that, let's have a look at lifetime rates of CLTs. Well, the procedure to calculate lifetime taxes are written in detail in these two areas, but make sure candidates should keep in mind that lifetime tax is only to be calculated for CLTs, because on PETs we only calculate death tax in death calculations, but only on those PETs after, after making those if individual dies within 7 years. But right now, let's focus on lifetime taxes. Now, how to calculate lifetime taxes on CLTs? Well, that depends which tax year it was your client is making CLT. Whether it was before tax year 910 or it was after tax year 910. Why we have to consider that? Because the nil rate band, which you guys could see right here, of 3,25,000, be a different nil rate band for every tax year, which will be obviously given in the exams. Well, why we are talking about nil rate band? What is the importance of nil band? The chargeable amount which we have calculated just in the above calculation for CLTs would be taxed first at nil rate and then at either 20% or effectively 25. But how candidates will be selecting whether the rate is 20% or the rate is 25% after application of nil rate ban? Well, that would be dependent upon who is paying the lifetime tax on these CLTs. If your exam says that upon lifetime tax on this CLT would be paid by donor, the applicable rate after application of nil rate ban will be 25, but it will be 20 if trustees are to pay the taxes. Well, most of the times it's mentioned in the paper whether the trustees will be paying the tax or donor will be paying the tax, and candidates know which rate is to be applicable. But if the examiner is silent, who is going to pay the lifetime tax on CLTs? Make sure always donor will, and the applicable rate will be 25%. Now, the first thing is how to calculate available nil rate band on any lifetime transfer. Firstly, you should calculate chargeable amount of the CLT, and in order to know what is applicable nil rate band on this transfer, we have to find out which tax year an individual is transferring to. For example, if an individual, for example, over here, as Alan is making following lifetime transfers, the first transfer which he made was at 30th of June 2008, 183,000 to a discretionary trust. First of all, candidates should consider what would be the chargeable amount for this transfer, and for that, you should consider whether there was any lifetime transfer in the same tax year in which we are making this transfer, that is tax year 2008-9. As we can see, there is no lifetime transfer in tax year 7-8. We will be able to deduct 2 annual exemptions out of this transfer of value. And so, after deducting 2 annual exemptions, the chargeable amount of this CLT will be 177,000. Well, in order to know whether it is gross chargeable amount or it is net chargeable amount, that is, whether 20% rate is to be applied or 25% rate is to be applied, you have to look into who's going to pay taxes. Trustees of first two trusts pay the IST liabilities. So the first trust, who is paying the tax? Trustees are. So I'm going to call it gross chargeable amount, and the applicable rates will be 20%, but after application of nil rate band. Now, in order to know what amount of nil rate band is applicable, candidates must look back 7 years from the date of transfer to identify what are the gross chargeable amounts of any chargeable transfers only, which have been made in previous 7 years. Whatever the gross chargeable amount of those transfers are, those will be deducted from the nil rate band of the current tax year, and then the remaining nil rate band will be applicable on this transfer, which I'll be explaining you with the help of this following example. Well, the first transfer which he made was of 183,000. Well, the first transfer which he made, as I already did the calculations for you, was 183,000. We deducted two annual exemptions out of it, that is 3,000 and 3,000, and we have a chargeable amount which is gross. So I used to refer it as GCA. Now we want to know what is the nil rate band for the tax year. For tax year 8-9. Well, it will be given in the rates and allowances table of your paper, exam paper. So from that, we just notice that the nil rate band for tax year 8-9 is 312. Now you should look 7 years before the date of transfer, and find out that if there are any chargeable lifetime transfers 7 years before this date. Well, as it was his first lifetime transfer, so we would not be able to find any gross chargeable amounts of chargeable transfers made in previous 7 years. So that's why full nil rate band would be applicable for this transfer. As the chargeable amount is just 177,000 and the nil rate band available is 312,000, there would not be any lifetime taxes payable. But the second transfer which our client made was on 30th June 2013. It was 150,000 made to his daughter. So, first of all, this transfer is not a CLT, it's a PET. Now, as we can see, it's a potentially exempt transfer. We will only be calculating the gross chargeable amount. Transfer value was 150. Now, why we are deducting two annual exemptions? Because we can see the transfer is made in the tax year 13-14, and there was not any lifetime transfer in any of the previous in previous tax year, that is 12-13, and that's why we will be provided with two annual exemptions, and we do not calculate any lifetime taxes on PET, just the chargeable amount. And we calculated this chargeable amount not for lifetime calculations. We calculated this if the individual dies within 7 years of this date. In that case, we will be applying rates on 144,000 and not on the market value on the date of death. So moving on to the example and the next transfer. Well, the next transfer was made on 30th of June 2014 of 191,000 to a discretionary trust, which will be considered as a CLT. Now, we should focus that this transfer is made at 30th of June 2014. Now, considering 30th of June 2014, which means the tax year would be 14-15. Now, we can see we had annual exemption of previous tax year. Now, in 14-15, we will only be available with only one annual exemption. And so, the chargeable amount is 188. Now, as the question said, trustees of first to trust will pay the ID. So that's why, again, I'm going to call this chargeable amount as gross chargeable amount, which is 188. And once again, we have to know what is the available nil rate band. And for that, this is what we are required to do. First of all, what is the nil rate band for 14-15? Well, that's 3 to 5 after and of 9-10. If it is 9-10, it is 325, and for following tax years, all of it, it is 325,000. Out of 325,000, we will be deducting gross chargeable amount of all the transfers which were chargeable transfers made 7 years before this date. Now, if you will look into 7 years before this date, we have one chargeable lifetime transfer with a gross chargeable amount of 177,000. And that's why we will say, whereas remaining 40,000 would attract a rate of 20%. So, applying this 20% rate, we will be having a lifetime taxes of 80,000. Well, so this is how we calculate lifetime taxes on CLTs. Well, the next CLT which our client made was on 31st December 17 of 256,000, and again it's towards a discretionary trust which will be considered as CLT. So the fourth transfer, which was made on 31st of December 2017, which means tax year 17-18. And so we will be again provided with two annual exemptions. As we can see, there is no lifetime transfer in 16-17, and the chargeable amount is this time net. Now, why it is net? Because we can see from the question part that Alan paid taxes on last gift. And that's why we will say whatever the chargeable amount will be, that would not be considered as gross chargeable amount. Rather, it would be considered as net chargeable amount. When I say net, I precisely mean net of tax chargeable amount. Now, the chargeable amount which we have right now is 250,000. The nil rate band for 17-18 is 325,000. Now, if you will look into 7 years before this date, you would not say that we have two chargeable lifetime transfers, because 7 years before this date would be a date that is 31st of December 2010. Now, if I say this 31st of December 2010, well, that means 7 years before, we only have one CLT. This one does not fall into 7 years, and this is already packed. So only one CLT with a gross chargeable amount of 188. So we just deducted that, and available nil rate band is 137,000. Well, the taxable amount after deduction of nil rate band is 113,000, and the applicable rate is 25. Why? Because donor is paying the tax, and in this case, 28,250 is the tax. Now, candidates, if I want you to calculate gross chargeable amount, because the one which you calculated was net of tax, but now you have net of tax amount, you have tax. If you add them both, you will end up with gross chargeable amount. Why we have calculated gross chargeable amount? Well, the answer lies in application of nil rate band, because whenever we deduct any value of CLTs made in previous 7 years, what value we are required to deduct in order to find available nil rate band? It's not net chargeable amount, it is gross chargeable amount. So for instance, if this client would make any CLT after this date, and you will be considering what are the chargeable transfers made in previous 7 years, you would not be considering 250 for this transfer, you would be considering 278,250. And this is how we do lifetime calculations on lifetime transfers. Now, this is how we calculate lifetime taxes on CLTs and chargeable amounts only for potentially exempt transfer. Well, now we should consider that how to calculate death taxes on the same lifetime transfers. Well, for that, we would have to move on to the next example. Well, I've written what are the payment dates of the taxes you have just calculated during lifetime. The taxes which you calculated on the CLT 8000 and 28250. If you want to know what are the payment dates, I have written over here, and so the payment dates are also written over here. So you can read them up and apply them up over here. In order to calculate death taxes on lifetime transfers, once again candidates would have to start from lifetime calculations. When you would be done with lifetime calculations, then you should consider death calculations on same lifetime transfers. And to do that, let's have a look at following example. Well, Mr. Ambroses made following lifetime transfers. Well, the first one is a CLT and Mr. Ambrose to pay the IHT. Second is a pet made to her niece on 21st birthday. Third is also a pet made on occasion of marriage, so don't forget to deduct marriage exemption out of it. 11th of November, 136,000 to a discretionary trust. Trustees are to pay the IHT. And what we are required to do is we have to calculate IHT liabilities as a result of lifetime gifts. And then we have to do that again, but this time if Ambrose dies dies on 14th of February 2018 after making these transfers. Calculate additional IHT on the lifetime gifts as a result of Mr. Ambrose's death. So the first part is requiring you to do lifetime calculations on lifetime transfers, and second part is requiring you to do death calculations on lifetime transfers. So I would give you like 3 to 5 minutes in order to consider the answer for part A, which is for part A. Well, as we can see, the first CLT was of 205,000, and after exemptions, we are provided with full nil ban on first CLT, and that's why full nil ban was applicable. And due to that, in fact, there were no taxes on this transfer. So we can say as there are no taxes, net of tax chargeable amount and gross of tax chargeable amount would be same. Well, the next pet which he made was of 60,000, but as we can see, there was a transfer in tax year 910, so we will be able to deduct one exemption and the gross chargeable amount will remain 57,000. The next transfer was made to niece on occasion of her marriage. So that's why firstly we deduct marriage exemption of 1,000 for anyone else, and then annual exemption, and again just one annual exemption because there was a transfer in previous year. So gross chargeable amounts remains 130,000. Well, the next transfer which was made over here was made at 11th of November 2015. And in this transfer, as it was a CLT, and we can see the transfer was made in 15/16, and because of that, we will be able to deduct 2 annual exemption. As trustees are to pay the tax, this is already a gross chargeable amount. Well, what would be the nil rate band available on this transfer? For that, for tax year 15-16, it is 325. And what are the chargeable transfers? What are the gross chargeable amount of the chargeable transfers which are within 7 years before the date of transfer? Well, in fact, if we look into 7 years before the date of transfer, we can find only one CLT with a gross chargeable amount of 199,000. So available nil rate band is 126, and the chargeable amount is just 140, is just 4,000. As trustees has to pay the tax on this, so applicable rate will be 20, and this is the lifetime tax which we need to pay. Well, as it was the transfer on which trustees were paying the tax, so it was already a gross chargeable amount, and that's why we need not to add this 800 to it. And so the gross chargeable amount remains 130,000. Now, if you want to know that how to do death calculations, I think the first thing which you should consider is which of the transfers would attract further tax on death. Well, all of them, with after making those, if individual dies within 7 years, would attract death taxes, but those after making home individual dies after 7 years would not attract lifetime taxes. Death taxes. So for that, what we are required to do, there are two ways to do it. How this I do this is, I just find out a date which is 7 years prior to the date of death, which would be, in this case, 14th of February 2000. So any transfer which is made before this date and any transfer which is made after this date. Before, I think we do not have to do any death calculations on those. But any transfers which are made after this date would certainly be within, would certainly be those transfer after which Mr. Ambrose did not live for complete 7 years, and that's why they would become chargeable on death. Now, looking at that, we can easily identify only last two transfers would become chargeable on death. Now, looking at IST payable during death. All right. As we can see, only last two transfers became chargeable. Now you should consider that in the lifetime calculations, we had 4 transfers, out of which we are doing death calculations on only last 2 transfers. But when we will find out the death mill rate band on death calculations, still rules remain same. We will be deducting gross chargeable amount of all those transfers which were made 7 years before the date of transfer. I repeat, not the date of death, the date of transfer. 7 years before the date of transfer, all those all those transfers which are chargeable, we have to consider their gross chargeable amount, and we have to deduct that from 325, and remaining nil rate band would be available. Now, when you would say on death, this pet would be considered as exempt, but this pet would be considered as chargeable. That means if this pet is now to be considered in death calculations, you should not be calling it PET, as it is a chargeable transfer, and this would also be using nil rate band. But as far as this PET is concerned, this would not be using any nil rate band, as it would be considered as an exempt transfer on the death calculations. Whereas if the CLT falls into 7 years before the date of transfer, in that case the CLT would still be using nil rate band, although it did not become chargeable on death. So keeping those things in your mind, This is how you should be doing the death calculations. Well, first of all, I have imported the chargeable amounts, gross chargeable amounts of both transfers which became chargeable on death. Now, the nil rate band to be used will be of the tax year of death, which is 3 to 5,000. Now, if you want to know how many chargeable transfers do we have from the date of this PET, well, that would be all those transfers which are made within 11th November 8 to 11th November 2000, the 11 June 2004 to 11 June 2011. Now, if you want to see that, we can see that from the lifetime calculations. I think both of them falls within 7, but you would not be counting for this pet because this pet is now on death, it is exempt, but this CLT will still be considered or called as chargeable transfer. So, keeping those things in our mind, we will only be deducting 199,000 because the other transfer was a pet which has become exempt on death. So available nil rate band is 126,000 and 4,000 are taxable, but on death we do not apply 20 or 25, rather we apply 40% rate after the application of nil rate band, and that's why I have applied 40% rate on this, and then we have to deduct taper relief. In order to know what is the amount of taper relief available or what is the percentage of taper relief available, candidates need to know what is the duration within the date of transfer to date of, well, right now if you will count that, that would be something around more than 6 and less than 7. What amount of taper relief is available? For that, you would be provided, you have to remember this table, which I think is not provided in rates and allowances. So, if there is a duration of 6 to 7 years, the applicable taper relief percentage is 80% of the death IST which we have just calculated. Now, you can see from the answer part that we had calculated a tax of 40%, which is 1600. Now we would say that as the duration within the date of death and date of transfer is more than 6 years but less than 7 years, which would attract 80% of 1600, and there will be a taper relief of 1280. So the IST payable on this potentially exempt transfer, which has now become chargeable, is 320. But if you want to know what is the nil rate band applicable on the second transfer, which became chargeable on death, once again we would consider 325, the nil rate band in the tax year of death, and then we'll be deducting the chargeable amounts of all the transfers which were made within 7 years before. Now, as we can see from this CLT, if we want to know what are the transfers which are made within 7 years, in fact, all of them. But candidates, you have to find chargeable transfers. The CLT is called chargeable transfer, so this would be counted for. This PET is now called exempt because donor dies within, donor lives for 7 years after making this PET. So this one would not be counted toward nil rate band. But this is not PET anymore. This is now a chargeable transfer. So what we are required to deduct is two gross chargeable amounts. One is of 199,000 and other of 130,000, which makes up a total of 3,29,000, which means effectively there is almost no nil rate band available. So 130,000 would attract a rate of 40%, which is 52,000, and then we will be considering application of taper relief. Well, for this one, I think taper relief would not be applicable. Reason being, because he died within 7 years of, within 3 years of making this transfer. As you can see from the table, if the duration within the transfer and date of death is up to 3 years, applicable taper relief is zero, and that's why we would not be calculating any taper relief. So the tax which is payable on death so far is 52, but as it is IST, we will be able to deduct the lifetime tax I was mentioning earlier when I was discussing that table, and that's why payable tax is 51,200. Now, let's have a look at the third requirement of the same question. Well, the third, and that is all, by the way, that is all about lifetime calculations on lifetime transfer, death calculations on lifetime transfer, and now we should be discussing how to apply nil band on death state. Well, in order to learn that, we should consider giving answer to part C. Well, part C says we have to calculate if there is any nil rate band left to set against death state. Well, for that, candidates must consider if there are any chargeable transfers within 7 years from the date of death. Well, if you want to consider that, you should keep in mind the date of death of your client. Well, the date of death is 14th of February 18, and 7 years before to that will be 14th of February 2011. And so we can say, yes, there's a chargeable PET and there's a CLT. And what is the applicable nil rate band for death state? That would be 3,25,000 minus 130 and then again 130. So we will be available with a nil rate band of 65,000 for death state. But as we have not discussed how to compute death state, but if whatever the death state of Ambrose would be, let's say if it is 200,000, how you're going to calculate death tax on that death state? Well, available nil rate band is 65. If it is 200,000, for 65,000 would be at nil, and above amount would be taxable at 40%. So, after completing this example, we can easily say, now we are able to calculate lifetime taxes on lifetime transfers as well as death taxes on lifetime transfers. Now, we should consider some reliefs applicable on these transfers other than the ones which we discussed already. Well, one of the relief which we can discuss right now, as we are done with the lifetime calculation as well as the death calculations of someone, it would be easy to discuss fall in value relief. Well, fall in value relief is only applicable in death calculations for those transfers. After making those, make sure if the value of asset increases, we still pay tax on the same GCA calculated while lifetime calculations. When Ambrose made this 134,000 transfer, a land which was been transferred, if by the date of death of Mr. Ambrose, this land would increase in value, we would still be paying tax on whatever the GCA we calculated. By the way, we calculated a GCA of 130,000 for that. But if examiner says that value has been fallen, let's say it was 134,000 and now it has been reduced by the date of death. You were doing death calculations. Let's say over here examiner would have said that the value of that asset which used to be 134 has been reduced to, let's say, 130, that means we will be able to deduct 4,000 from this 130, and then we will be applying nil rate band and 40% rate. So it is quite a win-win situation for the taxpayer. If the value of an asset increases after making a lifetime transfer, we still have to pay taxes on the same GCA. But if the value of an asset decreases after making a lifetime transfer, we get to deduct fall in value relief. And then we apply nil rate band and full rate bands. Candidates should keep in mind that if the donee had sold the asset before the date of death of donor, in that case, the fall in value would not be difference of value of asset at the date of transfer and date of death. Rather, it would become the difference in the value at the date of transfer and date of sale. Because I think if the donee had already sold the asset before the date of death, donee have not faced all the reduction in value of the asset as he has already sold it before the date of death. And that's why we are not provided with fall in value, which we have not faced or realized. Well, one of the important things we heard earlier that there are in fact 9 exemptions available, but we discussed only 7. As I said, that we're discussing them. Okay, as I said, that we will be discussing them after a few examples of lifetime calculations and death calculations. Now, let's have a look at business property relief. Now, this is one of the important relief as it can make any transfer even exempt because the relief applicable is CLT. Well, we will be provided with the business property relief upon any property which fulfills both of the following conditions. Well, the first condition is that the property which we are transferring is relevant business property. The criteria for property being relevant is written down here. And property was also held for a minimum period of ownership, which is usually 2 years. 2 years before the date of transfer, donor must held that asset in his ownership for at least. Let's have a look at both of them in more detail. Well, if an individual in your paper is transferring assets of an unincorporated trade, but make sure he's transferring all of his sole traded trade or all of his share of partnership in any business which he had held for complete 2 years of minimum period of ownership. In that case, 100% of the transfer of value will be the business property relief, and you will be left with you'll be left with no chargeable amount to be considered. Well, this reduces to only 50% if the asset transfer must not be charging any rent for the use of this land and building, because any land and building which is used, which is rented out, is usually not considered as a business asset and so not relevant business property. Could all of you hear me loud and clear? Because from my side, the connection got broken once or twice. Kindly reply in my chat. Reply me in my chat. Would be transferring, if your client would be transferring shares of such a company which is unquoted and also a trading company in nature of the business. Once again, if these shares are held for a minimum period of ownership, we will be provided with 100% BPR of the transfer of value. But if these are not shares, if these are securities of an unquoted company, again 100% BPR would be available, but only if the donor has voting control in that particular company. Well, if these are shares and securities of a quoted trading company, I usually used to say to my students, you can assume kind of that we are usually not provided with any BPR on transfer of quoted shares or securities because the conditions attached are a bit difficult to comply with. We are provided with 50% of transfer value as BPR, but only if the donor has voting control in a quoted company, which seems to be a bit difficult task for an individual. So if you have one, no problem, you will be able to apply 50% of the transfer value as BPR. But if there is no control, there is no BPR available, and in that case, you will be considering other seven exemptions. So, if in the exam any of these things have been transferred, you should consider the second thing and then apply BPR, and that is whether the individual holds the asset preceding the date of transfer. But if someone has not held them for complete 2 years, still we might have two chances. Still, we might have chances to claim business property relief by considering exception to the rules to the minimum period of ownership. Well, rule is that you must hold the asset in your ownership before transfer for at least 2 years. Well, in exception to the rule, we'll be studying something that the client would not have held it for complete 2 years, but still replacement of previous relevant business property. And at the date of transfer, when I look at ownership period of both properties, for previous 5 years preceding the date of transfer, if the combined ownership of both properties is at least 2 years out of 5 years before the date of transfer, we will still be able to claim BPR. But candidates on lower off, not on transfer of value compulsorily of the asset which has been transferred today, we have to consider value of the asset which was previously owned and value of the property which we are currently transferred. We have to consider both values, and whatever the lower value, we will only be able to claim BPR on that. Okay, moving on. Moving back to where we were. So we were discussing that if an individual does not hold a relevant business property for complete 2 years, still we would be having a chance to claim business property relief. But if he says that this property was purchased as a replacement of some other property, and we have to notice 5 years preceding the date of transfer, not 2 years, in total 5 years, and in those 5 years we have to consider the ownership of previous asset as well as ownership of new asset. In those 5 years, if we have any 2 years, minimum 2 years, in which combining the ownership of both new and old out of previous 5 is 2 years, we will be able to claim BPR, but only on the value whichever is lower off the value of the previous property and the value of the property which we are transferring today. The exception to the rule which we have over here is successive transfer. Well, that applies when someone says that he is transferring an asset which has not been held for complete 2 years, but he acquired this asset succession from someone else. So this asset was actually received by your client. It was not purchased by him. He received it from someone. And that someone, when transferred this asset to your client, was qualifying for BPR. That means he would have held it for complete 2 years. And either the first person who transferred this to your client or your client are dying. Only then we will be saying that it is a successive transfer. In this case, still we will be able to claim BPR even if our client did not hold it for complete 2 years of ownership. Over here we have a small example relating to replacement property rule. Well, we can see at 31st December 16, an unquoted trading company, JKL Limited, was taken over by MNO Limited, another unquoted trading company. That means your client would have owned JKL Limited shares and they have now been replaced with MNO Limited shares, another quoted company. Much had owned or for takeover. Well, she owned the previous shares for complete 4 years, and the consideration on the takeover consisted of ordinary shares in MNO. So she owns the previous shares for 4 years, and now she have new shares, which are replacement of the previous ones, by the way. On 30th June 2017, Marsha gifted her shares in MNO Limited to her sister. Now, she received these shares of MNO on 31st December 16. She wants to transfer them after a year. Now, we have to consider, although MNO Limited is an unquoted trading company, but still we need to know whether the minimum period of ownership was complied or not, which is certainly 1 year in this case. But we can see, as MNO Limited shares were acquired as a replacement of previous relevant business property, that was JKL Limited. So that's why we can say surely she can apply exception to the rule of replacement property. And so she is when she's transferring, the transfer value is 160, but what was the value of previous shares? 110. And so now we will say that from the date of transfer, that is 31st, that is 30th of June 2017, we have looked into previous 5 years, and over here we can see is a combined ownership of 5 years, just two. So we are comfortable in saying that we will be able to apply BPR over here. So 160,000 was transfer value of JKL Limited, but we have to consider the value of both assets. As we know, value of the previous asset was 110 and the new asset is 160. So lower of both would attract 100% BPR, that is 110. As this was her first transfer, we can deduct 2 annual exemptions, and so the chargeable amount is 44,000. Well, the next problem which we may face in application of business property relief is, as we said, either it is quoted company share or it is unquoted company share. Both cases, it is compulsory that it has to be a trading company. Now, what are the companies who are considered as trading companies? Those companies whose main source of income is trading profits only. Any other income which you may see in the corporation tax pro forma may be gain on chargeable business assets. So, if a company has any non-business asset in its assets portfolio, this will make that company a partially non-trading company, and this will limit our availability of BPR. And in this case, how BPR is calculated, we are not allowed to take 100% of the transfer of value. Over here, we need to find the business proportion of transfer of value of shares according to the proportion of assets owned by the company. If the company owns 80% business assets, only 80% of the transfer of value will qualify for BPR. If the company owns 50% business assets and 50% non-business asset, again your transfer value, only 50% of your transfer value would qualify for BPR. So make sure there is 100% BPR available on that part of transfer of value whichever belongs to business proportion of the company. And that's why we use a formula, which is whatever the transfer value your client is doing, divide it with total assets of the company and multiply it with only the business assets of the company. Whatever comes, that qualifies for BPR, as the relief is named as business property relief, not business property relief. So that's why. Over here, we have an example in which Wendy gifted 40,000 shares in STU Limited, an unquoted trading company they are claiming, but to a niece on occasion of her marriage. So marriage should keep in mind, you should keep in mind there's a marriage exemption of 1,000 of anyone else. Wendy had owned the shares since 2003, and on 31st May 17, shares were worth 180,000. On that date, STU Limited owned assets worth 500,000. By the way, transfer value is 180, and now we have to look into the details of STU Limited's asset, which is owned assets worth 500,000, which includes an investment property, which happens to be a non-business asset. So we got a problem in claiming 100% BPR on the full transfer value because company is not completely trading, company is partially trading company. And so we'll say the transfer value is 180 as we discussed, but we are not going to apply 100% BPR because it is unquoted company. We will qualify for 100% BPR, but we are not going to apply on full transfer value. We're going to divide it with the divide it with the total assets and multiply it with the business assets of the company, and those are 450 over 500, and so we'll deduct 1,000 of marriage exemption and 2 of the annual exemptions. Well, in order that the BPR which you have just claimed and the gross chargeable amount is 11,000, now we should consider that how BPR would react on death calculations. I think if Windy would live 7 years after making this transfer, we should not be considering anything, as this transfer would become an exempt transfer on death calculations. But if she would die within 7 years, this transfer would become chargeable, and candidates must consider whether the BPR would remain or it will be withdrawn, because there are 2 reasons that we sometimes on the death calculations we need to add the amount of BPR back, and we have to calculate a new GCA. When we have to do that? Whenever BPR is withdrawn. Okay, so when do we need to add this BPR back in while doing the death calculations? If any of the following 2 happens. If the relevant business property is not used for business purposes by the date of death of donor, that it was a business property, for instance, it was a building which was used in trade. I transferred it, and when my client in fact transferred it, and when my client died after like 4 years, this transfer becomes chargeable, and we find out Dhoni is not using this building for business purposes anymore. In this case, we have to add back the BPR calculated in lifetime calculations to the GCA, and we have to increase our GCA with the amount of BPR. The other reason why BPR needed to be added back or withdrawn in the death calculations is that Dhoni had sold the property before the date of death of donor, so, and did not replace it with the relevant business property. So if any of the 2 are happening, you must add back the BPR you calculated while the lifetime calculations. Well, the next relief out of the 9, we said we are done with 8. The next relief which we should discuss is agricultural property relief. Once again, just like business property relief, agricultural property relief is also available or applicable if both of the conditions are fulfilled. One is property is a relevant agricultural property, and second is if it was held for a minimum period of ownership. Well, if you want to know which of the properties are considered as agricultural properties, first of all, make sure other than land and building, and okay, let's talk about shares in a while. Other than shares, what are the assets which could have been considered as relevant agricultural property? Candidates, make sure it has to be either land or building. Anything other than land and building could not be considered as could not be considered as agricultural property. But there are many lands and buildings, which of them should be considered as agricultural? Those land and buildings which are used for either cultivation or your animals. But make sure not your agricultural produce, not your animals. Both of them are not agricultural property, they are business property. But the land and building which is used to either cultivate crops or to have your animals, that land and that building is considered as agricultural property, including your farmhouses and farm cottages. But as we know, there are two values of every agricultural property. There is agricultural value and there is development value. Only the agricultural value would qualify for agricultural property relief, not the development value. As far as shares are concerned, shares could also qualify. Shares could also qualify for agricultural property relief, provided that these are shares of a farming company and the individual has voting control in that company. Regardless of this company being quoted or unquoted, whatever this company is, it must have to be a farming company that is its main source of earning is farming, and individual must be more than 50% shareholder, or individual must have voting control in the company. But this makes up that what are the relevant agricultural properties, but we have to consider what are the minimum of ownerships. Well, over here, we have to look into whether we are self-farming those farms which our client is transferring, or these farms are tenanted by our client and he do not do self-farming. By the way, if your client is doing a self-farming, percentage of BPR is APR 100% of agricultural value, and the minimum period of ownership is 2 years. As far as those clients who wants to transfer their farms, which they do not farm themselves, rather they are tenanted, for them, make sure minimum period of ownership is not 8 years. It is 7 years, but percentage of APR, in the instance when tenanted lands attracted 50% agricultural property relief, is when both of the following conditions are fulfilled. Well, are quite unlikely to be. So you can say either tenanted or self-farmed, mostly rate would remain 100%. By the way, exception to the rule applies on agricultural property as well. And same goes with withdrawal agricultural property relief. It remains if the relevant business property is not relevant business property by the date of death of donor, or the relevant business property has been sold by the donee. Same points apply in agricultural property. If relevant agricultural property is not used for agricultural purposes by the donee by the date of death, or by the date of death of donor, he had sold the property and not purchased any replacement agricultural property. Both cases, we have to add back this APR into the gross chargeable amount, which we calculated in the lifetime calculations. So let's have a look at this example. Well, I would suggest that you should not be reading the answer to this example. Rather, you should try it by your own. Okay, I can read it for you, and then you would be solving it, or you can have a look at example and want to solve it. Zach plans to gift his farming business 20,000 farming business and 20,000 cash to his grandson. So actually, the transfer value will be whatever the value of the farming business would be, plus 20,000, whatever the cash we have. So 20,000 plus whatever the value of farming business would be, that would be the transfer value. To his grandson on occasion of his marriage. In 2017-18, he has not made any other lifetime transfers in previous 7 years. Zach lives on a farm and has owned and worked the business for last 17 years. A surveyor has recently valued Zach's farm and its land, agricultural value, development value, market value of the farm, land and building, animals and inventory, plant and machinery, motor vehicles, market value of the farming business 1.23 million plus 20,000 cash. So the transfer of value would be 1.25 million. But first, we need to decide what are the assets which will qualify for APR, what are the assets which will qualify for BPR. As we know, he is transferring farm along with this business. So, farming business is itself an unincorporated business. And these are assets of an unincorporated business. So, if these are assets of an unincorporated business which has been transferred, it would equally be entitled to claim BPR, but not on agricultural value. As on agricultural value, we will claim APR. This development value will qualify for BPR. Why? Because these lands are self-farmed. That is, these are used in a trade carried out by Mr. Zach, and his trade is farming business. So this development value will qualify for BPR. Whereas if these lands would have been tenanted by Mr. Zach, in that case, we will only be able to claim APR on agricultural value, and BPR would not be available upon development value if these lands were tenanted, because tenanted lands are considered as non-business asset and would not qualify for business property relief. So right now, as it was self-farmed, that means these lands were used in his own business. That makes it a relevant business property. Animals in inventory are also qualifying relevant business property. Plant, machinery, and motor vehicles also relevant business property. Now you can go through the answer and find out that how we apply both BPR and APRs if we have to. I hope you would have a good look, and effectively, if you guys would have noticed that if there would have been any chargeable amount that would come out of this 20,000, because if you have a closer look on breakup of 1.23 million, the 600,000 will qualify for 100% APR. This 400,000 will qualify for 100% BPR. This 150 will also qualify, and 80 will also qualify. In fact, this 1.23 million qualifies for 100% BPRs and APRs. And so this 1.23 million has been exempted. Well, but we still had 20,000, which is written 200,000 by mistake in the answer. So 20,000, which would attract, in fact, marriage exemption of 2,500, two annual exemptions, and that's why the gross chargeable amount is 11,500. Now, if we, this is a related property rule in order to calculate transfer of value, which I'll be discussing with the help of following example. Well, we did some examples of calculation of transfer of value earlier. So what is the difference within both of these? Now, for that, you have to look into this example and notice that what is the difference. Well, earlier, our client owns all the units and he was transferring some of them to his son. Right now, Sarah owns 2 antique chairs, which is set of 6, which is part of set of 6, and her husband owns another 3. So, first of all, let me tell you what are who are the people who are considered as related parties. Well, that would be either the client's or donor's spouse and civil partners, or an exempt body, that is charity or political party. Well, if Sarah would have owned few shares over here, as well as her brother or her nephew or anyone other than her civil partner, spouse, or any exempt body, we would not have been applying related property rule to calculate transfer of values. But whenever we know that our client owns few units and her spouse or civil partner owns few units, in that case we will be using the formula for calculation of value of state. I repeat, formula for value of state, not transfer of value, because we calculate value of state before transfer, we calculate value of state after transfer, and whatever the difference is, that is transfer of value. So in this scenario, as we know, there is there are in fact 6 units. Two of them are owned by our client, and her husband owns another three. That says there's a total related property of 5 units. Well, our client owns two, so we still have to find value of state for 2 units, but this time value of state for 2 units would not be 15,000. We will we will be using this formula in order to calculate value of state before transfer of 2 units. Well, what is the formula? Formula says value of total related property. Well, total related property means Sarah owns 2 chairs, her husband owns 3 chairs, so we need to put a value of 5 chairs over here. And then we have to multiply it with A over A plus B. A is value of state of donor's state, value of donor's state, and B is value of the other related party state, that is right now her husband. So A would be value of 2 units and B will be value of 3 units. And I repeat, applying this formula would not give you transfer of value. It would give you value of state in respect of 2 units owned by Sarah. Because when you will be dividing 5 units value with 5 units value and multiplying with 2 units value, you would be ultimately getting value value of state in respect of 2 units. And then you have to do that, apply this formula again after transfer. How we have to do that? Let me explain that with the help of this example. Well, as we know, before transfer, Sarah had 2, her husband had 3. So the value of total related property would be of 5 chairs, that is 60,000. I'm multiplying it with value of 2 chairs, that is 15, and divided by 15 plus value of 3 chairs. And that's why this is value of state, which is before transfer. Now, after transfer, she would transfer 1, and after transfer, will be left with 3 units of the related party, 1 unit of the client, and now we will apply the same formula again. And this time, related property will be 4 units, that is 40,000. So 40,000 into value of 1 chair over 1 plus 3. And so value of state after transfer is 6660. And that's why we can see before transfer value of state was 22500. After transfer it remained only 6667, and the transfer of value is 15833. But candidates, in the case of shares, A and B are changed to either number of shares or percentage of shares rather than value of shares. This is the only difference which we have to consider if the asset transferred is not an asset, it's a share. Well, I have given some examples along with their solutions so that you can try for shares as well. Well, After discussing these topics, we can comfortably say that we can come to the adjustments which we have to make in respect of death state. Now, as far as death state is concerned, what are the common adjustments which we see in the exams mostly? We'll be discussing only those. And so let's have a look at that. Well, the main performer says that we should list all of the assets the deceased person had owned. We should deduct all of the liabilities, and then we should deduct whatever he left for any of the examined body, that is charity, political party, or his spouse or civil partner. After deducting this, we are left with net chargeable state, in which we have to add either gift with reservation or settled property, which we may not be able to see in every other question, but in some questions we do. We'll be discussing shortly that what is gift with reservation and what is settled property. Well, once you have the chargeable state, as we discussed in the question of Mr. Ambrose, that how to apply nil rate ban. We said from the date of transfer, you should, from the date of death, you should consider how many chargeable transfers do you have within 7 years before the date of death. And you should deduct their GCA from 325, and whatever is remaining nil rate band, you can apply on this chargeable state, and remaining state would attract a rate of 40%. Doing so, you would end up in what are your taxes on this gross chargeable state. Next thing would be to consider if any of the following reliefs are applicable to be deducted from the IHT. Quick succession relief and double taxation relief. Well, quick succession relief is applicable whenever we can see that while preparing this death state, there was an asset which our client inherited or acquired through gift of someone, and that asset would get taxed twice within 5 years because of the death of our client within 5 years of the previous death. So we'll be discussing how this is applicable and how to calculate that amount. Well, in the introduction of DTR, obviously, we will be doing that only and only if individual had some overseas properties in his or her death state, and they were getting taxed twice. So, and we do not have any double taxation treaty with that country. In that case, we calculate foreign tax suffered, we calculate what was the tax suffered in UK, whatever the lower tax is, we can deduct that one. Well, these are the main points in the death state. These are few details that how we compute different values. You should give it a good reading. I'll be starting to discuss from settled property. Well, candidates, whenever you see that you are dealing a client who is life tenant of either interest in possession trust or immediate post-death interest trust, make sure for such individual, we will try to find out that what is the value of assets held in this trust. Whatever the value of these assets would be, we would be reporting that value in his or her death state. But after computing net free state. But after computing net free state, we will add whatever the value of assets of this trust will be given to us in exams according to your syllabus. It would be given. You just have to put that value in the death state, naming settled property. Now, as you guys would have a basic idea that in IPDI trusts, life tenant has all the rights to incomes and benefits of the assets held in the trust. And that's why when life tenant dies, these assets pass on to to another party, which is usually referred as remainder man. So that's why when lieutenant dies, HMRC requires us to consider all these assets kind of belonging to the deceased person, because he or she was the one who enjoyed the possession of these assets, either their benefit of use or the incomes which has been generated. All the rights remains with life tenant of such trust. So that's why these are reported in the death state of the life tenant, considering the substance was that these assets belong to the life tenant, as he was enjoying all the benefits, enjoying all the possessions. So that's settled property, which we were discussing. Well, the other important topics in the death state which you might consider, well, in if you want to know that how to apply a basic level of question and how to consider settled property, I have given an example over here with its solution. You can give it a good reading in order to know that whether things are smooth or not. Okay, the quick succession relief which we were discussing. First of all, you should remember quick succession relief is a relief which is to be deducted from tax, not the chargeable state. We have to calculate available nil rate band on that state. We have to apply 40% rate. We'll be left with IHT on chargeable state. From that IHT, you should deduct quick succession relief. If you have noticed that in the death state of your client, there was an asset which was getting taxed for the second time within 5 years because of two immediate deaths, because of the two deaths with a duration of less than 5 years. In that case, candidates would be required to calculate what was the IHT which was paid in respect of this gift on first death, and what is the percentage of QSR. Well, the percentage of QSR would be dependent upon what is the duration within two deaths. For example, when we see in the following example, um, if you would have a look at the following example, we would be able to discuss QSR in a better way. Stray died on 1st January 2018, leaving an estate valued at 180,000. So, leaving a estate valued at 180,000. In estate, there are shares of Q PLC valued at 120 at 1st January 2018, obviously his date of death. He received these shares at his father's death at 1st November 16. Now you can see the distance within these two deaths, duration within these two deaths is less than 5 years. When, when the shares were valued at 90,000, gross chargeable state of his father at 1st November 16 when he died was 600,000. IHT paid in respect of his father's death state was 110,000, and Mr. A had one lifetime transfer of 380,000 to his brother at 15th May 2017. Well, right now, we are required to calculate IHT payable by Mr. A on his death state. Now, for that, as you know, the gross chargeable state of our client is 180,000. But in previous 7 years from the date of death, there is a transfer of more than 3,25,000, which means there is no nil rate band available set against death state. And that's why this and 180,000 would attract a 40% tax, which will be a tax of 72,000. Now, as you know, in his death state, there was an asset which was shares of QPLC, which are getting taxed on your client's death for the second time within 5 years. You must tell yourself that I have to deduct QSR from this tax. Well, what would be the QSR? that will be IST on first death multiplied by some percentage. Well, that percentage would be dependent upon what was the duration within two deaths. Well, his father dies at November 16, so November 70. So that is, well, November 16, November 17, we cannot say November 18 because Mr. A died before that. So it will be 1 to 2 years, and that would be a QSR of 80%. Well, how to compute IHT on first death? I think that's quite easy because we will be provided with certain figures which will help you to calculate this amount. Now you can see these three things. When these shares were transferred at that date, what was the gross chargeable estate of his father? That was 600,000. The total IST paid on his father's death estate was 110,000. And what was the value of this asset on first death? Well, that was 90,000. We'll say this was the total tax paid on his father's death on a total estate of 600,000. We don't want to know what is the tax of total estate. We want to know what was the tax in respect of 90,000. So this will be the IHT on first death, which is 16,500, of which 80% is quick succession relief, and remaining is the IST payable. So hope you got an idea of quick succession relief. Well, moving on to double taxation relief. Well, that would be dependent upon whether we have a bilateral treaty with a country where our overseas property resides or we don't. Because if we have that, in the exam, we will be provided that whether that with overseas country you could do have bilateral treaties or not. If there would be, you should read out the treaty, because in that case, this property would not be getting taxed twice, because treaty would be allowing it to be taxed in any of the one countries, and candidates must find out by reading what is the treaty given in the exams. Whereas if the exam says there is no double taxation treaty between UK and that overseas country, in that case, candidates must find out what is the IHT on the overseas asset in overseas country and what is the IHT in UK on this overseas property. So you have to find out overseas tax on this overseas property and UK tax on overseas property. Whatever would be lower, that would be considered as your DTR. Now we have an example which deals both QSR as well as DTR. Well, in this example, Peter died on 15th of August 2017, leaving an estate valued at 3,75,000. Estate included property situated overseas at 60,000. So in this state of 375, there is a property valued at 60,000, which is overseas property. Overseas IHT of 18,000 was paid on this property. Now we can see overseas tax on overseas property will be always given in your exam. So you just have to pick that value from the paper, and then the second thing which candidates are actually required to calculate is UK tax on overseas property. And how we are going to do that, we will be looking at that shortly. The state also include a 4% interest in quoted shares that Peter inherited on the death of his mother on 10th of November 2014. At the time of her death, shares were worth £50,000, and on Peter's death, they were worth 115. In order to calculate IHT on first death, you must consider value on first death. Well, IHT of 80,000 was paid on a total estate of 400,000 on his mother's death. Now, you can use these three figures to calculate IHT on first death, and you can compare the date of death of Peter's mother and date of death of Peter in order to find out whether what would be the percentage of quick succession relief. Right now, November 14, that will be November 15, November 16, but not November 17. So that would be 2 to 3 years, most probably. Well, Peter had made no lifetime gifts and he left entire estate to his son. So that means if someone has no lifetime gifts, all of his nil rate ban would be applicable on his or her death state. So let's have a look at solution. Gross chargeable state value was 375 as there was no lifetime transfer prior to 7 years of date of death. That's why full nil rate ban is available. And the taxable amount out of the state is 50,000. Now, this 50,000 would attract a rate of 40%. And firstly, you guys have to deduct QSR out of it. Now, in order to calculate IST on first death, this was the total IST paid, this was the total state, and this was the value of shares. And at that time, it was 2 to 3 years. So 2 to 3 years would be attracting 60%. And so 6,000 is the QSR. Whereas, if you want to know what is the amount of DTR, in that case, you should consider what are the taxes before DTR. Well, those are 14,000. Now, if you want to know what is overseas tax on overseas property, we already know that. That is 18,000. But what is UK tax on this overseas property? For that, you should consider the total state is of 3,75,000. The total tax before DTR is 14,000. What you can do is 14,000 divided by 375,000. This is a very easy way to find out what is an average state rate which is applicable on the death of our client. So that is approximately 3.733%. Now, if I want to know that what was the tax charged on this overseas property, that's quite easy. Well, this overseas property was worth 60,000 on his death. 14,000 is the tax and 375,000 is the chargeable state, and that's why the effective average state rate is 3.733. So the tax which we suffered on overseas property at UK is double to 40, and at overseas country was 18, and lower of both is certainly 18, and so that's why lower of both will be certainly double to 40, and that's why we have deducted double to 40, and IST payable on Peter's death is 11760. Reduced rate on death state. Well, this applies when someone left substantial charities, substantial legacies to charity. Well, this is what we already know. Well, let me get back to the death state so that I can explain that in a better way. This is what we already know, that if someone left anything for a charity, that is excluded from the chargeable state because this is an exempt transfer. But this is just one benefit. If someone left substantial legacies to charities on death, there is another exemption applicable, that you will still be able to deduct all these charitable donations, but the applicable rate would reduce. Rather than the after application of nil rate band, we will be applying 40, we'll be applying just 36%. But when are we gonna do that? So from now onward, you should make a habit that if someone's will says charitable legacies, you must consider the application of 36% rate. And how you should consider that? You have to calculate 10% of baseline amount, which is calculated. Whatever the gross chargeable state which you calculate, as I told you on the death state, you have to deduct available nil rate band, and you have to add back the charitable legacies into it, and that would be called as baseline amount. Or another way to do it is you should calculate only the taxable state after application of nil rate band and add back charitable legacies to into it. Whatever comes, that is baseline amount. That is not the limit. You must take 10% of that, and that is the limit. Someone left 10% or more of the baseline amount. In that case, we apply 36% rate. For example, Han died on 1st May 2017, leaving an estate consisting of house, quoted shares, and cash. We'll add them up. Han owed taxes of 3,200 at his death, and in his will, 215,000 to his wife, 40,000 to Oxfam, a registered UK charity, and had made one lifetime gift to his son of 3,10,000 on 10th of April 2015. We have to calculate what is the IST due on Han's death. In order to do so, first of all, we should prepare his basic death state computation, in which I just put his family home, quoted shares, and cash. All right. These were the assets which Han owned at his date of death, and these were the liabilities he had. And so the free state is 628,800. Then we will deduct spouses and charitable legacies, and we are left with a gross chargeable state. We are left with a gross chargeable state of 3,73,800. Well, what is the available nil rate band? As Han had one lifetime transfer. Let me show you in the working. As he made a lifetime transfer of 3,10,000 within 7 years before the date of death, which is of 304, and this pet would ultimately become chargeable on his death, and that's why available nil rate band is 325 minus 304, that is only 21,000. So with this 21,000, this is the available nil rate band. So that's why we are applying this additional nil rate band. So after application of nil rate band, we have gross chargeable state of 370,800. If we deduct nil rate band, the taxable amount is 252,800. Put working 2 over here and go to working. As you can see, in his death state, you deduct charitable legacies. You have to compare these charitable legacies with the 10% of baseline amount. If these charitable legacies will be 10% of the baseline amount or more, we would be applying 36% rate. But if they are not more than 10% of the baseline amount, in that case, we will be applying only 40% rate. Now, if we look at the taxable amount, we add back charitable legacies. The baseline amount is 292,800. 10% of that will be 292,800. So, as the charitable legacies are quite sufficiently more than the 10% of the baseline amount, the applicable rate, which I used above, is 36%. Well, this is reduced rate of charitable legacies.